And we should now be able to see the attendee list, and it tends to fly up pretty quickly.
People are coming in.
Yeah, absolutely.
Great.
Are you at the office today, Richard?
I am, yeah.
Okay. I've come into the WeWork over in Liverpool Street, and it's getting busier. I've been coming for the last few days, and it's getting busier and busier now. So
Yeah, there are a lot of people in central London. I noticed it was the first time. I mean, I normally cycle, so I haven't been on the train very much, but I noticed on the train, I had to leave my bike here the other day, last time I was here. And I came on the train this morning, I noticed on the train, it's the first time it's not been possible to get a seat, but there's nowhere near possible to get a seat like before COVID.
Yeah,
it's my first experience of that on a train in the past 18 months.
I've noticed the same on the overground.
Yeah.
Hey guys, we are 16, and we'll give people just a couple of minutes to join. Hope everyone's been having a good time in the first week at their internships. Let us know. Put some comments in the chat. Let us know where you are, what you're doing. All right, we'll give people one more minute and then we can get started. So everyone, today, thanks all for joining us again for our third masterclass session of this cohort. We've got Richard Anton today from OxVC, and we're going to be running through fund mechanics shortly. We just a couple of little bits of housekeeping. I've had a few messages from people who have asked about the previous masterclass videos. They will all be uploaded on Friday afternoon. So if you go back into Notion, you'll be able to find the previous two sessions as well as today's session listed there as well. And then the other little bit of housekeeping is if you haven't yet joined Slack or Notion, do reach out to me. I'll put my email address in the chat box. If anyone's having any issues getting access, then do let me know. And actually one more point to make is a few of you have asked about the mentor program, which we're finalizing. So we've got all our mentors, we're allocating mentors to interns, and you should hear from us next week. So by next week, you'll know who your mentor is, and you can kick off with your first 30-minute session. Great. With that, Richard, I'm going to pass it over to you to take over and take us into fund mechanics.
Thanks very much, Seb, and welcome everybody this afternoon. It's a pleasure to have you all here and to be able to share with you. My name is Richard Anton, and I am a long-time venture investor. I came into the business out of business school myself in the mid-90s, 1994. And other than 2 years in a software company where I was responsible for running business development and finance between 96 and 98, I've been in the venture sector the whole time. initially with Apax, which way back then was a venture firm, and they did about 50% venture and 50% small buyouts. And then for a long time, I was with Amadeus, which is a well-known UK firm. Most of you have probably heard of it. And then at the start of 2017, together with my co-founder at Ox, who's based in Stockholm, he and I founded Ox as a scale-up stage investor in B2B SaaS companies. Along the way, I've chaired the BVCA, so I've been very involved in the industry in the UK and more broadly in Europe and Israel. So I'm going to talk to you today about fund mechanics. Okay, so the context is that venture capital is there to satisfy two needs: the needs of investees and of investors. We focus a lot in our work on the needs of investees, but the needs of investors are very important as well. And fund mechanics really derive from these two need sets. This is a lot of information I'm going to take you through on this slide about investees, in other words, entrepreneurial companies. So entrepreneurial companies need funding for the most part. Some are bootstrapped and can manage on their own cash flows, but for the most part, entrepreneurial companies need funding. Now, the environment or context in which those companies exist is one of endemic and uncertainty that persists over the very long term. And I've highlighted here a few of those elements of uncertainty. First one is the time scale to commercial traction. It's really hard to know how long it's going to take before the product or service that the company is developing is going to take off commercially. Second is the costs until you get to commercial traction. And that's partly because of the time scale effect and partly because there can be elements that you need as you achieve product market fit that need to be changed that may cost you more to develop. Third uncertainty is pivots. Companies often have to pivot. It's rare that the original idea will be exactly the one that achieves product market fit. And sometimes the changes can be fundamental or revolutionary, hence a pivot, rather than evolutionary. Another source of uncertainty is execution success. It's very difficult to create a new business, to create a new business model, find a route to market, and so on. Another one is leadership changes. Normally, a startup would be founded by a group of people, a group of founders. Not all of them will typically be there for the whole of the startup's journey. As some people don't work out, either fall out with one another, or they're not kind of the right person as the company reaches the next stage of its evolution, or they change what they need to get changes there. Another one is cash flows until break even. So this is after commercial traction, until the company reaches a point where it's profitable in terms of the cash flows in its own operations. You don't know what those cash flows are going to look like, and you certainly don't know up front. Next one is financing markets. At the moment, as I think probably everybody here knows, we're in a period of exuberance in the financial markets, and it's a very benign environment for financing. If we were holding this class in 2009, just after the global financial crisis, we'd be saying exactly the opposite. So financing markets are highly cyclical. Another uncertainty is vulture behavior. This is sort of apocryphal. When companies get into trouble, and it's rare that companies go from A to B in a straight line, A being startup and B being success. There are normally wobbles along the way, and during those periods, you can get vulture behavior by financial investors, and I'll describe some of the things that can happen. Next source of uncertainty is exit timeframes. Exit is normally actually determined not so much by the needs of the seller, but by the needs of the buyer, the acquiring company, or the public markets that might take the company take the company public. Most exits happen through acquisition, and acquisitions are typically determined by the strategic product roadmap of the large acquiring company. Think Microsoft or Google or somebody like that. And they'll have strategic needs as they survey their own business that it's very difficult to understand from the outside. And then finally, another source of uncertainty is to do with expansion opportunities that can be inorganic, which can be M&A, or it can be doing a joint venture in a new geographic market, or the like. So lots and lots and lots of uncertainty. And that means that equity is the right way to finance these companies. And equity means that the investor would take a share of the ownership of the business, and then is there on the roller coaster with the other shareholders who would be the founders. And debt or lending is not the way to finance these businesses, because there's an obligation to repay that money with interest. And because of all the uncertainties I've just described, startup companies can't predict when they're going to be able to repay, and it's probably a very long term and beyond the time horizon of lenders. Okay, so it's equity, and that begs the question: how much equity and how often? You'll have heard quite a lot about different stages of funding, and I'm going to take you through an illustrative example here. So let's talk about a company that's going through successive funding rounds, from seed funding, and I'm using an example here where the seed funding might be £1 million, to Series A funding. I'm saying that might be £8 million. Series B funding, I'm saying that might be £15 million. Series C, which is a later stage funding round at £40 million, and potentially later funding rounds that could be more advanced and potentially more substantial than that. Now, this is a pretty linear sequence, and these are typical values. Things do kind of move around here, but this is a good place to start. So let's talk about who might invest those rounds. A new lead investor for the round could come as a seed investor at the beginning, or a Series A specialist, or a Series B specialist, and so on for the later rounds. What do those mean? Well, at the seed stage, what the investor is looking to achieve in partnership with the entrepreneurs is evidence of product market fit. At the Series A stage, the investor and the other shareholders and entrepreneurs are looking to demonstrate evidence of repeatable and scalable and ultimately profitable, and in the short term that means profitable unit economics of a growth model. And then at the Series B stage, that's when you're ready to scale. And then Series C is scaling in a much more meaningful way, and so on. So that's what the different rounds do. And let's work through an example of the different investors that will be coming in. So at the seed round, a seed investor might invest £1 million. That's straightforward. At the A round, a new lead investor, Series A specialist, if it's an £8 million round, might invest £6 million. Typically, investors would want to have, in this kind of situation, would look to have a stake of circa 20%. So given that new shares are being created, the seed investor would want to participate as well, so that they can maintain their stake. To maintain your stake at 20%, you'd want to buy 20% of the newly issued shares, and that means you'd be investing 20% of that £8 million, and then your stake wouldn't change because you've got 20% of the old shares and you're investing for 20% of the new shares. In my example, we've rounded that up from £1.6 million to £2 million. So these are round numbers. And then when the Series B round comes, the same thing happens again. A Series B investor comes in this case, they might invest £9 million out of that £15 million. And then the Series A and seed investors would both want to do about 20% of that, so £3 million each. You're beginning to see a pattern here, that the seed investor is following on with pretty substantial capital beyond their initial investment. And the same is true for the Series A and Series B investors, as I'll show you. So when it comes to the Series C, you see the same kind of pattern again. And then later, if there's a later round, I'm saying a seed investor might drop out by then. Hopefully, if the company is doing well, those rounds will be happening at a very high valuation, so the seed investor isn't kind of suffering too much. Eventually, the Series A investor might no longer invest in new rounds. Series B investor might continue for longer. So I've put the totals on the right there. So seed investor that's initially put in £1 million ultimately might invest £6 million. Series A investor that started with £6 million might ultimately, in this example, invest £17 million. The Series B investor that started with £9 million might ultimately invest £17 million plus if they've come into to later stage rounds. There's one conclusion from this, which is that investors must reserve. If you don't reserve, and let's take the example of that Series B round, say the company needs £15 million and it's not performing very well. Things have gone wrong, and you're exposed as a company and as the investors to vulture-like behavior. So an incoming investor, the Series B investor investing that £9 million might say, well, yeah, I'll provide £9 million, but it's going to be at a pretty low price because this is a difficult, high-risk situation. If the existing investors don't participate and sort of stand their corner in those situations, they're going to get very heavily diluted. So it's a massive risk for them. On the other hand, if it's a positive situation, an incoming investor would probably want to see the positive signaling value of existing investors coming in as well. So lots of reasons why investors need to follow their money. This is from an investor perspective. It's a little bit easier for entrepreneurs because entrepreneurs, even if a vulture investor behaves in the way that I've described, they need to look after the entrepreneurs and make sure that they've got plenty of equity. That's a kind of venture capital 101 thing that entrepreneurs have to have a lot of upside in the game. So that is normally less difficult than the situation of earlier investors. So that's what a kind of series of company rounds might look like. And then let's look at it from the investor perspective, investors going into the venture capital asset class. Well, why do such investors come in? There are really 6 reasons. One is the risk return profile of the types of investments that an ultimate provider of capital can be making in this sector. It's high risk, and if things go well, potentially high return profile, and that's very different to lots of other asset classes. If you go back to very dry finance, from a portfolio theory, you'll want to have exposure to a number of different asset classes, and you'll want to include within your mix of investments this kind of high risk return profile. Second is exposure to tech. We all understand how tech is a massive secular shift in the global economy. Third reason you want to invest in this asset class is help with opportunity selection. It's very difficult if you're a provider of capital to know and have the expertise in where to invest. Fourth is you need active ownership. The model here is active engagement between the venture firm and the entrepreneurial company. So ultimate providers of capital need that. Next thing they need is diversification within the sector. You are taking an excessive risk with pensioners' money or wherever your capital is from. If you invest in one or a small handful of companies, you really need to have some diversification. Venture capital provides that. And finally, exit management. Entrepreneurial companies are not liquid investments. They're private companies, and selling your shares is a difficult thing to do, whether it's through a trade sale or an IPO or a sale to a financial buyer or some kind of secondary sale, and that also needs expertise from the venture investor. So that's from the investor perspective. And to answer these needs, enter VC funds, which are provided by VC managers. Now I'm presenting here a very simplified diagram, but it covers the essentials of what all of this looks like. So I'll draw your attention to a few things. So at the bottom here, in this example, there are five companies. These are entrepreneurial companies that are receiving investment from the fund. So the fund raises money from investors. They provide capital into the fund. So that's the fund. And then the VC, a firm like my own firm, Ox, is a manager of the fund. So the sponsors would set up the fund. I'm a sponsor, my co-founder is a sponsor. We've set up the manager. Ox is a manager of a fund, and the fund we're currently managing is Ox1, then there'll be an Ox2 and Ox3 and so on. So funds change over time. The manager is a consistent vehicle over a long period of time. The manager is a company that employs people, and it needs revenue to be able to do that. That revenue comes in the form of management fees from the fund or from the funds if there are more than one fund over time. And then in terms of the economics of this business, the profitable part of the business is what's called carried interest, and that's a share of the profits of the fund. I'll come on and explain how that works. And carried interest is paid into an entity called the general partner. So a fund has sort of two owners, if you like. One is the mainstream investors who just provide capital. They're called limited partners. And then there's the members of the executive team of the manager. So that sort of sits alongside the manager. That's called the general partner. And when the fund makes profits, general partners will receive carried interest. And I'll come on and explain more about that. So that's a basic structure of how this looks. Now we'll dive into the economics of it. So I'll start, there are three elements. I'll start with management fees. So just to recall the prior slide, these are the management fees that get paid by a fund into the manager. Management fees are typically somewhere between 1 and 2.5% per annum per fund. So as I mentioned, this is the revenue of the fund management company, and it's used to cover salaries and rent and so on. For very, very large funds, like large private equity funds, it's closer to 1%. For smaller funds and very actively involved funds, like at the seed and venture stage, it's normally between 2 and 2.5% per annum. So those are fees that are paid to the manager. Next element is carried interest. So once limited partner investors, so this is the main money, have received their capital back, profits are split. In Europe, this is typically done on a whole fund basis. And what that means is that all of the money that's being invested in the fund and then invested into companies has to be returned to the fund and returned to investors. So they get all of their money back before profits are divided up. A lot of people have observed that the lemons mature faster than the pearls. So this means that in the early years of a fund, there are losses. And the really good companies tend to take longer to come through. And that means that it's a number of years before a fund pays back in full. And this is a really good example of a deferred gratification business, because carried interest typically tends to pay out in years 7 to 12 of the life of a fund. So you've got to be pretty patient. You've heard about the kind of history of venture capital going back to sort of merchant ships hundreds of years ago, where profits were split 80-20, and that's typically the ratio in venture capital today. Sometimes the profit share that goes to a general partner, to the executive team, can be more than 20%. That tends to be for more established funds that have typically been in the business for decades, but most of the industry is operating on a 20% split. And that goes to the executive team, as I say, through the general partner. There's a but here, which is that often investors are saying, well, this is fund investors in the funds are saying, well, it's not good enough just to get my money back. I could have just put it under the mattress for that. I need to get some basic rate of return, which is typically in the 6 to 8% per annum range. And they say, well, the profit share will only start after that. That's called a hurdle. So as a fund manager, you have to clear the hurdle before you get to share profits. So that's how carried interest it works. There's another element which is often forgotten about, but is an essential element of the economics, which is capital commitments. So I mentioned that the bulk of the money comes from limited partners, institutional type investors. Some of the money also needs to come from the executives, the general partner. And it's always the case that the general partner, i.e. the executives, will invest at least 1% of the fund. It can be much more. For firms that have been going for a long time with general partners who've made a lot of money in the past, it can often be much higher. Figures of 10% can be quite common. Within an executive team, typically the broadest shoulders contribute the most of this. This GP commitment has been a big barrier to entry in the industry in the past, and actually very relevant to future VC and diversity VC. It's been a sort of a source of exclusion from the industry. That's now becoming quite well appreciated across the industry, and I don't think this is a fully solved problem, but it's partially solved. So in firms like Ox, we make sure, as we're developing people through the firm, that younger people who don't have a lot of capital don't have to put much capital in to do this. Otherwise, this becomes a very exclusionary business, and that's really the last thing that we want. But in the past, it has been a feature of this industry, an unhelpful feature of this industry, in my opinion. Okay, I'm now going to take you through returns, what returns look like, and a worked example. So LPs typically look for funds to return to them 3 times their money. That would be over that 7 to 12-year period. That's seen as good, and if a fund manager can produce that consistently, that's a really good fund manager and a venture firm that's going to succeed in raising money over the long term. It's worth noting that only 5 to 10% of VC funds actually achieve returns of 3 times or more. So that's a sort of a surprising and dark fact about the industry. But for funds to succeed and last in the long term, that's what they need to do. So the example is, let's imagine a fund that's 150 million pounds and then invests in 15 portfolio companies, each taking an average of 10 million pounds of funding. It's an active engagement model. So a partner in the fund has to limit themselves to a certain number of boards. I'm saying here 5 boards, 5 company boards, because a partner would typically join a company board. So that means you need 3 partners to invest that fund. Across the portfolio, 1 in 3 of the companies may well fail and return 0. That figure of 1/3 is called the capital loss ratio of the fund. Capital loss ratios for the earlier stage and riskier the investment fund, the higher the capital loss ratio typically. Typical figures in the industry are actually in excess of this. They're somewhere between 40 and 60% for venture funds, even for the best venture funds. And 1/3 of the companies, in my example, might return just get the money back 1 times. So that's going to generate 50 million pounds. So to make the 3x return of 450 million pounds, that means that 5 companies, the remaining 5 companies, have to return 400 million pounds. So that's an average of 8 times each, i.e. 80 million pounds per company, which is 8 times the 10 million pounds of investment that they've succeeded. If you assume a 20% stake, and that's a guideline, the number I mentioned earlier, rather than a kind of anything fixed, that means each company needs to be worth £400 million or more at exit. Now, within that cohort of companies that succeed, there's actually also a power law applying, and there'll be a distribution of returns. So probably more likely is that there'll be one, I've called it an HM unicorn, as in Her Majesty's unicorn, as in £1 billion rather than $1 billion. So you might get one of those that returns £200 million. That would be a 20 times return. So that's a real outsized great return. And 4 of them might return £50 million each. It's 5 times return. So each company will be worth £250 million. So that's a sort of typical nature of a good portfolio that provides an acceptable fund return. Okay, now let's look at the economics of the fund, of the fund manager. So let's say the manager is taking a 2% fee, which is probably about the right level for a venture fund that's £150 million in size. So that means there's a £3 million annual income for that firm. So where's that money used? Well, there'll be rent, travel, all of those kind of things. Let's say they probably consume about £1 million. 3 partners in the fund, there might be about £1 million for them, including all the on costs, social security, all of those things. That might mean a maximum £250,000 per annum in salary and bonus. Very importantly, this has to be subject to a damping function. This is the element of cost in a firm that can flex, and for a firm to maintain cash balance and to be able to kind of ride out any stormy weather it might experience, that needs to be managed down. So that's a variable element, not unlike the partners in a accounting firm or law firm or other professional services firm. And then other professionals in the firm, there might be £1 million for them that would pay their salaries. And you'd want to have a really great group of people, some in the investment team, in kind of up and coming roles in the investment team, and others outside of the investment team, platform, internal accounting, other operations, those marketing, those kind of roles. So that's how the economics of a manager look. Capital commitments, I'll do that part first because it sort of directly pertains to this. Let's assume that this is a 1% GP commit firm. So that means £1.5 million of GP commit. As I mentioned, the broadest shoulders would bear most of that. So let's make a simplifying assumption that the 3 partners cover all of that, and that's £500,000 each for each of them. That money gets invested over a period of time as it's needed by the fund. So the fund draws money down from investors, including from the GP, over a period of time as it invests in companies. So let's say that happens over 5 years, which is a pretty good approximation. So that would average about £100,000 per annum that each of the partners needs to put in. And that actually has to be compared with the salary. So if you're getting an annual salary and bonus of £250,000 and you're paying tax on that, your income might be £125,000 to £150,000, and you're also required to be investing £100,000 per annum in the fund. So these are kind of very important figures to bear in mind in terms of the economics. So it's not a kind of it's not a highly lucrative area in the short term. However, the high alignment and high integrity way to make a lot of money in this area is through carried interest. So let's run through those figures. Let's say that the firm does return 3x, so it's £450 million. So that's £300 million of profit. And let's also, in this example, take off the lifetime fees. So that's 2%, and I'm saying over 10 years. So that's 20% of the fund, which is £30 million. So there's £270 million of profit. That's enough to clear the hurdle, whatever the hurdle is. And the partners or the GP in general would take home a profit share that's the 20% carried interest share of that, which is £54 million. So that's a lot of money. Typically, the partners in the firm might receive 3/4 of it, roughly £40 million, which is roughly £13 million each. So that's obviously a lot of money, with 25% for the other team members. So about the same again to be split between the other team members. That would be a kind of typical distribution. And as I mentioned earlier, that's likely to pay out between 7 and 12 plus years after the start of the fund, with probably the larger payouts happening at the end of that period. So this is you might call this a get rich slow scheme. So it's really after a long period of time that the sunny uplands appear, and that the sun comes out, and that the people working the venture industry make their money. Okay, so this if you love the area and you're willing to be patient in terms of your own income, sounds great. So then, how do you raise a fund? Hint: it's very, very hard to do. So let's look at the world of LPs. So the types of investors in funds. I've put here 8 different types of investors in funds. There are pension funds that hold long-term capital for to be used in pensions. So are pension funds reliable long-term capital for the sector? Absolutely they are, and there's lots of it. However, will they back emerging managers? Emerging managers are venture firms that are raising their first or second fund, or possibly their third fund, and they don't have a track record that can demonstrate that in that firm, under that brand name, they've been returning money and making profits for investors consistently over a long period of time. Absolutely, they will not. Second is endowments, like university endowments. There are a lot of these in the States. Are they reliable long-term capital? Absolutely they are, and there's lots of it. And will they back emerging managers? Absolutely not. Third source is sovereign wealth. This maybe should have three ticks, because there are enormous amounts of capital in sovereign wealth. But again, will they back emerging managers? Absolutely not. Fourth is funds of funds. So one of the challenges for pension funds and other investors is that they want to write very substantial checks, just as they might do in other asset classes, like in public equities or in infrastructure, for example, if they want to own airports or things like that. And those check sizes are too large to go into venture funds. So they'll often invest through fund of funds, and funds of funds will also have the skills to select venture fund managers. So they raise money from funds of funds, raise money from investors, and will invest it in venture funds amongst other asset classes. So yes, they're reliable long-term capital, not in quite such large quantities. Will they back emerging managers? Again, they won't. Again, they need track records. So where can emerging managers raise money from? Well, there are 3, possibly 4 sources, and it's these other groups of LPs. One is family offices. These typically are the fortunes of wealthy families who've built that money up through whatever entrepreneurial activity of the past. At Ox, for example, we have a German family office as an investor. They own, their background is that they built up a very large chain of supermarkets in southern Germany after the war, and then they sold them in the late 60s to one of the large German supermarket chains that's still active today. And since then, they've invested the gains from that in property and in this asset class and so on. And if you can build a relationship with them, they will consider backing emerging managers. They tend to be more entrepreneurial and less rule-based. Next category, which is very similar, is high net worth individuals. They can be reliable long-term capital. With the right relationship, they will back emerging managers. They again tend to be more entrepreneurial and less rule-based. Corporates are very different to all of the investors we've talked about. Corporates tend to invest more for insight and strategic reasons. That means that they're pretty flighty. In certain times when it's fashionable in financial markets for corporates to be in this asset class, and when they don't have pressure on their balance sheets, they're there. And at other times, when times are tougher, they're not there anymore. So not clear that they're reliable long-term capital. Sometimes they'll back emerging managers, but that's more patchy. It tends to happen where there's a particular alignment between a corporate and an industry sector or investment strategy that the venture fund in question is pursuing, whether there's a fit with that and the corporate wants a lot of insight. And then finally, there's the public sector, things like the British Business Bank or the European Investment Fund. Most countries in Europe have one of these as well. Not clear that they're reliable long-term capital. They probably are. And they're a major source of finance for emerging managers. These are the sectors that you really, or the types of investors that you really need on board to be able to start a fund. Okay, with that, those are the formal materials that I wanted to present, and I thought that from this point we might dive into Q&A.
Absolutely. Richard, thank you so much. That was so useful and insightful. But we have got a few questions, and if anyone hasn't yet put in a question and they really want to get it answered, feel free to add that right now. But I will go to the top of the list. So the first one we have is, how common are drag-along agreements in UK venture deals?
Yeah, so maybe I'll just explain what a drag-along agreement is. So I mentioned when I talked about one of the challenges in the sector about exiting, and exits can be tricky to arrange. They're tricky to find, and when you do find one, it's not always the case that there's unanimity amongst the shareholders to pursue an exit. So one of the ingredients of a shareholders agreement that gets set up when an investor comes in, and frankly, this also happens even with bootstrapped companies, say that there's a group of founders, and so let's say there's 4, 5, 6 individuals there. Even in that case, you'd need what's called a drag-along agreement, which is when a certain level of majority that you agree up front wants to accept an exit opportunity. The others agree up front that they will be dragged in those circumstances. That can be anywhere between a simple majority of 50% plus 1 vote to something much higher, and that's situational. So they're always there, but the terms of the drag-along agreements, so kind of what group is needed, whether any named individuals are needed. For example, if there's a key founder, the key founder might have to be part of it for the drag to be effective. That varies a lot.
Brilliant, thank you. I think there's one question here that you've answered already. Do GPs have to contribute to a certain percentage of the total fund amount to have some level of skin in the game and incentives aligned with LPs? So that was 1%, I believe you said earlier.
Yeah, as a minimum, and there's this dichotomy at work here, which I mentioned is as a thing that's in the past been exclusionary here, which has sort of stopped, which has been a massive barrier to entry in the business. A number of LPs are understanding that's an unhelpful barrier to entry, so they're finding ways around that.
Brilliant. The next one we have is, when we say that a Series C or later, when a seed investor drops out, does that mean that the seed investor stops investing further to maintain their stake and accepts the dilution, or are we referring to them being bought out by the bigger investors?
Yeah, that's a great question. Let me just go back to the relevant chart here, which is here. Both can happen. Historically, what would tend to happen is that a seed investor and all shareholders wouldn't be able to get liquidity until the ultimate exit of the business. There was a sort of almost kind of quasi-religious thing about not giving other investors money out. In the past 5 to 10 years, that's really changed, and early investors tend to be able to get liquidity. For example, because there's so much money flying around in the sector. I've given you the example here of a Series C at £40 million, and later rounds can be kind of much larger. There often is a pressure from investors for the company to take more money, because that's what the investor wants to invest, than the company needs. And that provides the escape valve for that is shareholders taking liquidity, and that does give seed investors an opportunity to take liquidity. So these days, seed investor would normally get the choice.
Fantastic. Maybe one for me when we've got this chart up. So I've seen similar levels at seed, Series A, Series B, and Series C. But in the news headlines, we often see outliers like UiPath come along and do, I don't know, £1 billion or something crazy at B. Would love to get some comments on kind of like how that happens in the industry, and maybe it's happening more often.
It's certainly happening more often now. We're in a very, very frothy period in the industry, and the financing markets for companies like this are exuberant at the moment. Some of that tends to go to secondary. Some of it in the way that I described for seed investors. Sometimes it can actually make entrepreneurs, rich, not just rich on paper, but rich in cash ahead of an exit. That can be okay, but it can also be problematic, because oftentimes that sort of reduces the incentive to provide an exit. And then, of course, it can provide companies with much more primary capital. So sometimes companies have very, very strong balance sheets. From a company's perspective, that can make sense if the valuation that they're achieving, and so the equity dilution that they're taking for that large round, is in the first case high valuation, low equity dilution. So very frothy markets that you've got today, it's sort of pretty rational also to take it as primary capital.
Brilliant, thank you. We've got one here, which is, what is the total hurdle rate over the lifetime of the fund? You mentioned it was 6% year on year.
Yeah, that's another very good question. Typically, it's either I've seen 6% and I've seen 8%. Those are pretty common. Sometimes it's expressed as a multiple rather than a percentage IRR as well. But typically, what happens is up until that point, whether it's a multiple or an IRR, all of the profits go to the LPs, and then you have what's called catch up. So you would after that, if you imagine kind of pound by pound money coming out, all of the money that comes out would then go to the GP, to the executive team, until you've reached that 80-20 ratio. So that's the catch-up period, and then it continues on at 80-20 after that.
Fantastic, thank you. Oliver's asked, aside from the GP's historic 1% minimum investment of the fund, are there other team members of the VC fund expected or allowed to invest?
Yeah, two great questions. So allowed to invest, yes. And I'll speak about Ox. We sort of very gently encourage it. And the reason I stress very on gently is we really don't want to be exclusive or make kind of, we don't want people to feel under pressure. Our policy is that we recruit people who are typically have circa 6 years of work experience, typically around late 20s or early 30s in age. And unless they've kind of unless they're wealthy through some other means, for the most part, they're not wealthy individuals. And we really don't want to select for wealth. We don't not interested in that as any kind of selection criterion. So we really don't want people to feel under any pressure at all to do it, but we allow it. In terms of requirement to invest for younger people, again in the kind of age range that I've described, our policy is to require people to invest a modest amount. It's of the order of £5,000 to £10,000, so that it's a bit of skin in the game. And as a firm, we finance that if that's difficult for people. So we'll it's typically that's not difficult because that's not an enormous amount of money. But if it is difficult for people, we'll finance it out of paychecks over a long period, or so that it's not painful. So as I say, our approach is we absolutely hate it that this could ever be a barrier to entry for people.
Fantastic. And we're seeing those kind of salary sacrifice type models appearing in funds and also kind of in corporates as well, where you get the ability to finance some of your shares in. That's great. We've got another question here. Why would a seed investor want to take early liquidity if the company is a proven success?
Can I answer back and ask what a proven success means?
So whoever put that question in there, please do give us a bit more context.
The world is littered with proven successes that then fail. And think Yahoo, and or Friends Reunited, or I don't know. We could kind of name. We could have fun naming hundreds of them. It's to be able to diversify your risks and accept some reward. It's normally a pretty good idea to take some chips off the table if you've had, as a gambler, if you've had a bit of a winning streak. This isn't gambling, but it carries across. It's normally a good idea to take some profits.
We've had WeWork thrown in as an example.
Great example. I love it.
Excellent.
Yeah, absolutely. A lot of seed investors would say, I'll take some profit and I'll let some ride.
Brilliant. Joanna's asking, what happens when a startup gets a lower valuation, a down round? Do the entrepreneurs have to give up more of their own shares?
Yeah, I touched on that when we were talking about this, but I didn't dive into it deep. So I'm really happy to do that. So yes, the entrepreneurs take dilution, right? Because everybody's getting diluted by new money coming in at an unattractive value. However, the entrepreneurs, if they're staying with the business, are an essential ingredient of success, and the incoming investors and the board that they're joining know that, and they'll reward entrepreneurs with stock options that will mitigate their dilution and may actually take the dilutive effect away completely, because founders are obviously, management teams are essential, and founders who are leaders in the businesses they have a kind of an emotional, they're the heart of the business, as well as the economic ownership of the business. They're really valuable. That's pretty well recognized. So they would tend to get at least partially made good through stock options. At least enlightened investors would see it that way. If an investor wants to be a vulture towards a management team, then normally they'll come a cropper.
Okay, excellent. We've got another one here. Could you elaborate on any mechanisms that you're aware of that investors or fund sponsors use to protect their invested capital from fraud or mismanagement, other than GPs or management reputation, the record?
Sorry, could you repeat that, please? I want to understand the level at which that is.
Yeah, no problem. So could you elaborate on the mechanisms that investors or fund sponsors use to protect their invested capital from fraud or mismanagement, other than GP's management reputation?
Oh, I see. So this is, I think this is talking about investment into the fund as opposed to the fund's investment into the underlying company. Okay. Yeah, it's a good question, and normally I'm thinking of the film Trainspotting 2, where there was a great, if anybody's familiar with that, there was a great example of the characters going and getting money for some Dockland development in Leith, and of course it was all nefarious. So and they fooled these investors. I think were public sector investors in that case in the movie. So there's a lot of reputation assessment. There's a lot of due diligence is done by investors on that to check that the people behind the VC manager in which they're investing are high integrity, have don't have anything dodgy in their past in terms of fraudulent behavior or whatever, so there's a lot of that, a lot of assessment of the individuals. They'll look a lot at systems, so systems of control, to make sure that kind of investment committee decisions are taken by a group, are scrutinized by a group, are then executed with controls over funds flow. There's quite a lot of due diligence about that. There are examples of kind of bad eggs. There was a guy in a firm in the States called Oak that I kind of had some dealings with some years ago that turned out to be a fraud who was taking money away. So it does happen. I haven't heard of that many examples of it. In fact, I can't think of any examples in the UK, and it's pretty rare in the US. But I mean, it does occasionally happen, but it's diligenced pretty heavily.
Brilliant. We'll do a couple more. We've got 5 minutes to go. If anyone's got anything burning, do add it, but we've got some here. A question about carry paid to non-partners. Whoever's posted this question said that they've heard that some emerging funds do pay carry to their associates and principals. Is that accurate? And if so, is it something like 0.5% of carry for an associate position? Is that kind of the level that you've heard?
I'll speak about Ox. We do. And we pay not less than 1% to members of the carry pool to members of the investment team, and at entry level, and sometimes it's higher. I believe that that's not common in the industry, but we think it's we're great believers in doing it. Fantastic,
great policy. You mentioned that this is a get rich slow type of business.
Yes, I'm afraid so.
With returns materializing after 7 or so years. Does this feature influence the rate of senior staff turnover in VCs? Curious if this is in essence creates a lock-in effect for people in the business, and is this something new joiners need to think about when entering this line of work?
Yeah, a great question, and absolutely yes. I'll answer sort of both questions. It influences the type of people who are going to join VC. The people who have an investment banking type perspective on their income are not going to find this model attractive, right? It is not annual bonus culture in terms of high income, because of this level of patience that's required. So you as a firm, you have to screen against that pretty hard, and frankly, that's there are 2 sides to that coin. The individuals need to screen against it, and it does indeed create lock-in, which itself means that partnerships need to be very careful about kind of who comes into the partnership, and about the formation of a partnership.
Fantastic. An excellent question here from from Oliver. How can the source of LP's wealth be invested into a fund be traced? How transparent are LPs? For example, progressive VCs may or may not have concerns around investing wealth with historic links to slavery and empire.
Oh, that is a really good question. Thank you for that. So there are checks that have to be applied. And they're actually regulated by the Financial Conduct Authority in the UK. We have to do anti-money laundering checks. All managers have to do that before admitting investors into their funds. So we have to check that the source of the capital is clean. We actually haven't implemented policies within Ox on where are kind of looking at the kind of long-term historic provenance of that money. But I've got to say, I don't think we've any of the types of investors that have had money for long enough to have been involved in slavery and empire have come into our funds. I mean, I gave the example of the the German family that's much more typical. It was a kind of post-war founded supermarket chain where that money came from. That's much more common. But it's a great question, and it's caused me to think about it. So when we're in the happy position of really old money being interested in Hox, I think we'll start to think about that. Thank you for the question.
Fantastic. I think we'll call it there. I think we're there. That was fantastic. Richard, really enjoyed the session. The group's given us some brilliant questions as well. There's a couple that I have made a note on, so perhaps we can get some answers back to you guys afterwards. If anyone wants to reach out to Richard, you're on LinkedIn. I suspect you're on social media.
Yep.
Yeah. Twitter. Is there a Twitter handle out there with Richard?
I don't really use that, but you can use frankly, you can use my email. I'll just put my email up here in the chat for everybody. It's ra@oxx.vc.
The most easy email for anyone to remember.
That is the plan.
Richard, brilliant. Thank you so much again. We'll catch up another time, and thanks for everyone joining in the session today.
Thanks, everybody.
Take care. Bye-bye.